Hey everyone, Signa here with the OEC. So in this video, I really just want to talk a little bit about perspective in our strategy. Recently in the community, we've been focused on getting really good entries and dealing with the money management. And somewhere along the way, the focus has really turned to a lot of short-term trades. A little bit has to do with the market. It's been a very volatile place. Hyperactive when the news comes out, very drastic, wild swings, and then uh, really hard decision making analysis on what's going to come in the overnight hours or from the weekends. So I get it. It's a kind of a combination of a lot of different things, but I really need to get everybody to step back again and start looking at these bigger trades. Wall Street can't determine what that next candle is going to do. None of us can. There's no tool, there's no study or indicator or setup or logic that's going to ever help you determine exactly what that next candle is going to do. If your trades are based off of that, you need to be prepared for about a 50% win rate. There's nothing wrong with a 50% win rate, by the way, if you're dealing with the money management side appropriately. When you don't, and you're just basically flipping a quarter, hoping that it goes the right way, and then you're using a really tight stop, you're going to lose a lot. You're going to get frustrated, you're going to get stopped out often, and then you're going to start moving your stop farther away, but you're not increasing your probability in the trade. You're still taking crap trades because you're not looking at the overall market. You're just seeing a setup form and pulling the trigger, but not giving price any room to run. So in this video, I just really want to get you to step back and look at the overall direction of the market in some of these moves that we've had and ask yourself, why didn't you get in and ride some of this price action through the day? Why were you so focused on getting just a little itty bitty move out of the market with really tight stops to get a really tight distance to bail out of the trade when you could have risked the same amount of money and kept your bias and held through the day, or at least held to a determined, probable, valuable target? When we're trying to look at the overall market, think about asking some questions from the market. Are we going to have a range day? What is price going to do today? What am I expecting to see out of price? Are we going to hold this range through the day? And if we are, where's the top and where's the bottom so I can trade the range? If we're not going to hold this range, what do I think it's going to do? Are we going to break and drop lower? Great. When can I get in? Are we going to break and run higher? Great. Where can I get in? What I notice a lot of you don't seem to be asking is, what should I do if? And instead of asking that question, you're just putting a stop in place and saying, well, I'm going to get in here and I'm going to put a stop in there. And whether it's a good trade or a bad trade, I'm going to let the stop manage my position. We don't want to let the stop manage our position, because if it's a good trade, we need to stay in and see it through. If it's a bad trade, we need to get the hell out regardless of our stop, right? There's nothing wrong with thinking it's going to break to the upside. We get in and it starts to drop and we realize, oh damn, I'm on the wrong side of price. I should have gone short, and get out of the trade. But just to pull the trigger every single time and let your stop determine if you are right or not, that's a horrible way to do business. You're going to continuously lose, and we want to fix that. So instead, we're just going to highlight this area here. We had no indication on this day that the market would crash and burn. It was a continuation of the previous day, which was a continuation of the previous day before that. We had topped out into this range, and we were just holding it through and holding it through. And here we are on the third day, really still asking the question, so what are we going to do today? in all likelihood, we were looking for a failure. And it's not because we can already see that it did fall. It was because this was the Fed week. So on Monday, everybody was already talking that Wednesday, the Fed was going to be coming out with our forward guidance. So there was a serious lack of participation, and the institutions were sitting out. For 3 days, we just stayed in this range across the top. Well, that is more often than not a signal before a market falls. Okay. Oftentimes you'll see a market run to all new highs and it'll kind of range there for a while before dumping. And yet it's kind of different when markets get to the bottom. A lot of times when it gets towards the bottom of a range and it's making a move, you'll see this V shape. The market will land into something and trigger a reversal and it'll just immediately pop out of it. Right? And that's the difference between market tops and market bottoms. And of course, there's no always to anything. But through this day that I had focused on, at the start of the day, we could have been asking the same question that we want to ask every day. Are we going to hold this range that we've been in? And if we are, where should I look to get in? How much am I willing to risk? Where could I put my stop to make my trade worthwhile? The blue line would have been a decent range. Even just looking back at the previous day, those lows would have been a good range, or the previous day before that. So it all just starts to come together, right? We had a low that we could use, and look at where that low actually is. We'll call it 31.90. Well, price continued all the way down to 31.80. That's a 10-point move that we would be taking heat. I'm not sure how comfortable you are with taking heat, but suppose that we didn't get in with all of our contracts, if we only got in with one, and we had another one waiting at 31.85, and we had our final one at 31.80, and then our stop below that. Since we already knew what the range was, we could ask the question, how much am I really risking with this many contracts staggered in the downside like that? And is that worth a run back up to the highs of this range? Because the highs of that range would be where my target to get out would be located. Now, I don't want to believe that we could hold all of the contracts all the way up. That's just wishful thinking. But we could fade our way out. We could get risk out and let a runner run and see what we got out of it. Okay, and this was the Fed day, by the way. So in reality, we wouldn't actually have traded this one particular day. It was a Fed day. But we could have asked the same question the day before. We want to ask that question every day. When we ask the question out of the market, instead of trying to guess what the market is going to do, it will give you answers. It really will highlight for you what's going on. So, for an example, if we pick this day here, we had a very aggressive downward move in the overnight hours, and at the bell, it didn't even really try to close that gap. This is a really big warning that more than likely we weren't going to recover. And all the news was really negative that day. Everything was just pointing to a downward market. So the bias was pretty much set. And then once it broke the open range to the downside, we had our answer on the day. Are we going to hold this range and recover? No, we're not. Now, you might not know how far it's going to run. And if you've already been through a lot of my training, you would have bailed out around lunchtime, or at least gotten risk out at that point. But you could have tried to leave a runner on through the move. It would be a lot better than trying to take 3 points and shutting down a trade when you really don't have any reason to believe that you need to get out other than, well, I'm just trying to take this little move and then I'm going to stop. Now, depending on your account size, this discussion might not really suit too well. If you're running a $300 account or maybe a $500 account, you really got to determine how much risk you're going to take. And you might only be able to take one contract. which means you can't get risk out, and you really do need a defined target, 5 points or 7 points or 10 points, and you kill the trade because you don't have any way to lock in profits other than closing the trade. And you can't let price come back up and violate your position. So a couple of things before I close. If you can't see where we're going on the day, you kind of got to ask, what are you doing trading? If you can't see where you're going for the one trade that you're going to take, maybe if you can't see the whole day, you should be able to see the next pivot. What are we likely to hit? And is it enough distance for you to get your trade before we hit that thing? If you don't trust the strategy, you don't trust the setup, you don't trust your skills to read the market, you really got to ask, what are you doing trading live? So let's dial back, get out of these little itty bitty trades that we're taking, start getting back to the way that we're supposed to be doing things, which is waiting for an appropriate setup, recognizing our risk to reward opportunities, pulling the trigger for that one trade, maybe two, getting our day done, and stopping for the day. Guys, I appreciate your time and attention. I look forward to seeing you at the next video.